February the 11th, and the markets have had a bit of a reversal this morning. We started out today just fine. We were breaking up after some good employment numbers, but the euphoria didn't last long. As you can see here, we formed a little mini head and shoulders and came crashing down. We'll see if we can catch ourselves in this area right now. So what happened? What went wrong? Three big fears managed to surface all at the same time. Fear over valuation. We're too expensive, too big for our britches. Fear of the AI bubble. And fear of the economy going forward. Let's break all three of those down a little bit. First, the valuations. One of the most basic ways to look at if a market is overvalued or not would be to look at a major index and see what the level of that index is. And there is cause for concern there. The S&P 500, depending on exactly what way you calculate the PE, would be somewhere between 28 and 30. This is much higher than a historical average of 16 to 20%. So yes, we could scare ourselves and we could argue that the S&P is very overbought. Bear in mind that there are 7 big stocks which account for about 53% of the recent rise in the SPX. So we could lose the support of those 7 stocks, and we could see the index go down, but that might not be representative of the markets as a whole. Next, the AI bubble. AI is still an unknown. We know it's going to be able to do a lot of things. We know it's going to reshape a lot of things. It is probable that it will put some people out of work. It is possible it will create other positions, other opportunities, other jobs, and we might just see a transfer of skill sets from one spot to another. That's possible. But the bottom line is we don't know exactly how it is going to affect everything. Even if we did, it would still be difficult to measure the exact economic impact on everything. One other thing we know is that tremendous quantities of money are being poured into AI development, research, and application. A lot of big names are trying really hard to win the AI race. That again is cause for some concern. You take a company like Amazon. If they do spend more on AI development than they made in the previous year, that's going to raise an eyebrow, and it has. So exactly what's going to happen with AI is still plenty to give us a pang of fear and cause everybody to react and drop the markets. Next, let's turn to the economy. We're going to have a changing of guard at the Fed. We don't know exactly what we're going to get with our new Fed chairman yet. A lot of indications he's a little more hawkish and going to be a little bit tighter on the money supply. We'll see if we're right about that. We'll see if that happens. If it does, that could make it a little tougher for the market to get huge multiples going forward. Also, we're worried about jobs. This again relates to the AI we were just talking about. Are we going to see huge unemployment? Is there going to be jobs growth in other areas? Are we going to be able to keep inflation under control? All of these things are big unknowns. Let's put this into a longer-term perspective. I've switched from a 1-minute chart to a 1-year chart. Here we were back with our tariff bottoms of last year. We've recovered nicely, but every single time there's a scare, we don't know how big it's going to be. This one turned out to be pretty extreme, but then we rose to higher highs. We have been at all-time highs as recent as 2.5 weeks ago. We tried to rally back up. Here's what we looked like with our scary day-to-day. we never know for absolute certain what the stock market is going to do. That's one of the things I love about it. It's a puzzle that you can never master, you can never completely solve. But part of the reason we bid up the values so high, part of the reason the PE ratio on the S&P 500 is so high above historical levels is optimism for the future. And I think that there's still a lot of cause for that. Overall, I am still bullish for this year. Overall, I'm still bullish for at least the next 3 years. And so a buying dip, which looks a lot less scary when you put it in a 1-day chart, a lot more scary when you put it in a 1-minute chart. Expect more of this. Expect the volatility, but also expect it to work its way higher throughout the year. Good luck out there. I'm pulling for you.